So today I'm going to do a fairly high-level presentation or discussion on Snowbirds and U.S. taxes. And this is not a pleasant topic, but dealing with the IRS rarely is. So according to BMO, there's about 500,000 Canadians who own real estate in the state of Florida. And I guess that has partly to do with the winters in Toronto, Montreal, and Winnipeg. And so I guess one of the first sort of main issues that people have to sort of worry about is at what point would you be considered a resident for U.S. tax purposes? And I hear a lot about this 183-day rule that people talk about. You know, like I wasn't in the U.S. for more than 6 months, I'm okay because, you know, like it's less than 183. But the truth is that how the rules are written is that you have to actually look back at not the days you are in the U.S. for the current year, but you also have to look at the past 2 years. So basically, how they do it is every day that you're in there in the current year counts as 1 day, obviously, but the preceding year is weighted 1/3, and the second preceding year is weighted 1/6. And that number, when you add those three up, that number cannot exceed 183. So the real number is about 122, because if you average spend about 4 months out of the year in the US every year, you will be very close to that magical so-called 183. So that's the thing that sort of catches a lot of people off guard because they operate under the notion of the 183 day per year. So what happens if you sort of cross that line? Like say your past 3 years, your average number is at that point. Then you'll be deemed to be a U.S. resident. And what that means is that you are subject to U.S. tax, not just on your U.S. source income, but on your worldwide income. So what you should do, or what Canadians do when they cross that threshold, is they file this closer connection statement with the IRS, and they claim that, you know, look, I know my days in the U.S. are over that number, but I am closer to Canada than to the US. So therefore, I'm not a US resident for tax purposes. And that statement, and it's a 2-page statement, and it's signed under penalties of perjury. And they have very detailed questions on stuff like, where's your home? Where's your family? Voter registration? Where do you have your health insurance? And so basically you prove to the IRS that despite the time that you spend in the US, you still have a closer connection to Canada. So that's one way that you can get out of being taxed on your worldwide income in the US. But that option is not available if the days you spend in the US in the current year is more than 183 days. Because when you cross that threshold for the current year, or if you have applied for a green card, you cannot make that closer connection statement. Then the option under this scenario is that you look at the treaty and you say, under the treaty, I tie break to Canada versus the US. And under Article 4, Paragraph 2 of the treaty, they have these set of factors that you look at in order to determine where you are in terms of your tax residency. And those things are stuff like, where is your permanent home? Where are your so-called center of vital interest, which would include where your family are, you know, where your club memberships are, where your bank accounts are. And then there's, you know, things like your citizenship. But the key to remember is that to the extent that you cross over that threshold in the current year, you would have to look at the treaty to get yourself out of the worldwide tax in the US. And if you tie breaks to Canada, then you're only subject to U.S. tax on your U.S. source income, not your worldwide income. And the form that you file to claim that is 8833, basically, to say that, I rely on the treaty, and because of the provisions of the treaty, I tie break to Canada versus the U.S. Now, the thing about this one is that if you use the tie-break rule, you actually have to get a U.S. tax ID number, whereas if you use a closer connection statement, there's no need for you to get a U.S. ID number. So by using this tiebreaker, you're sort of kind of in the U.S. tax system, if you will, because of the fact that you're going to have to get a U.S. tax ID number. And those forms are generally due on June 15th of the following year, unless you have wages that is subject to U.S. withholding tax, in which case that's due 2 months earlier. And then, people always wonder, so what's the downside? Like if I don't file this statement, or if I neglected to file this tiebreaker statement, what can happen? Like, what's the big deal? Well, the big deal is that if you sort of are required to file this closer connection statement and you don't, then in the eyes of the IRS, they can treat you as a U.S. resident and subject you to all the rules that apply by virtue of that status. So that means that all your bank account in Canada, you should have disclosed those because they're offshore bank accounts. And the penalty for FBAR, those Canadian bank accounts, they're very, very high. It's basically $10,000 per account. And the downside of not filing the tiebreaker statement is $1,000 US per income item. It's not per form. And this is not relevant for, people, but for a corporation, the failure to file a treaty form is actually $10,000. So the penalties are pretty severe. That's why it's important to make sure that if these facts are applied to you, that you are in compliance. And especially nowadays, I think since July of last year, Canada and U.S., when you cross the border, they actually track the days that you're in their country. So with that new information, it's easier than ever for the IRS, if they want to figure out who are should be on their radar screen. And I'm sure a lot of those Canadian snowbirds have, nice homes in the warm states like California, Florida, Hawaii. Because I think on the latest stats, for the 12-month ended March 2014, we Canadians spent a staggering $13.8 billion on U.S. real estate. So I guess what happens when you have U.S. real estate is a lot of times when, they don't just sit there, obviously, right? A lot of people, I think, for the right reasons, rent them out so that at least there's some cash flow from the property. And if you do that, there's basically two options to report that rental income. One is that, you get taxed at 30% gross because the treaty provides no relief on rents. They provide relief on royalties, which is defined as rent for the use of personal property, but real estate is obviously not personal property. So that's option number one, is you can pay 30% on your gross rent. And the advantage, quote unquote, if you can call it that, is you don't need to file a tax return. You just pay that 30% and you're done. The other option is you elect to be taxed on a net basis so that you get to deduct everything that goes with operating that rental property, like mortgage, interest, travel time to the property to quote unquote manage the property, depreciation. So if you make that election, then you're taxed as quote unquote a business, and you're not taxed on the gross basis, and you get sort of the net income taxed at the US tax rates. And the IRS actually gives you a fairly lengthy period of time to make that election. So for the year 2014, you actually have until October 15th of next year to make that election, to be taxed on the net basis. And then you file the 1040NR. And the other thing that a lot of people sort of don't do, but they probably should, is you should also give the management company or your tenant this form called WAECI to tell them that, that you're not subject to withholding because you're going to report this as a net income basis. Now, in terms of the life cycle of a rental property, when you want to sell it, beware that because it's real property, the gain will be subject to U.S. tax. Again, there is no relief under the treaty for real property, so the gain will be subject to U.S. tax. And there's a 10% withholding tax on the gross proceeds on the sale. Now, if you are in the situation where you can say, you know what, my net tax on the gain is actually less than 10% of the tax on the gross seed, then you can apply and you can get the withholding tax reduced. But again, like anything with the IRS, you have to sign this statement under the penalties of perjury, and you have to prove it out to them what your bases are and what your proceeds are. And also, there is no withholding on homes that sell for less than $300,000, but I think given the way that the U.S. real estate markets are, those are going to be far and few. And the last thing is, not only is there a 10% federal U.S. withholding tax on the sale of U.S. real property, there's also state withholding tax on FIRPTA. For example, California has got its own tax at 3.3% on top of the federal tax. And Hawaii, they call it HARPTA to make it sound happy. But HARPTA is a 5% tax on any stuff that you sell in Hawaii that's real estate. Sorry. So what's the best way to hold your U.S. real property? That's a question that a lot of people ask, right? And there are many choices, but there's pros and cons with each. So the simplest way is to hold it personally, right? And that way, there's actually some pluses because you would get the capital gain tax rate, which is lower. And also the taxes that you pay in the US, you would get a Canadian foreign tax credit. But the downside to that is that because it's a US property and you hold it personally, you're gonna be subject to US death tax on that property. The other option is to do it through a Canadian trust. And that way you would bypass the US death tax, but it's very, very complicated, and there's rules in Canada that can make this structure not as beneficial as you would think. You can always, and people have done this, but it worked okay in the past, but nowadays it's probably not a good idea, and that's to hold the US real property in a Canadian corporation. And the plus with this one is obviously you also skip the US estate tax, but you get no capital gain rates because you're not your corporation, and you also may get hit with shareholder rules, right? Where in Canada, you would get taxable income. The other option is to use partnerships, because under that scenario, the income will flow to the partners, but again, there will be complex filings with that structure. And the last possibility would be to use an LLC, but the fact that it's a hybrid, it causes quite a number of issues and problems. So, unlike Canada, where when you die, everything you own, unless they're sort of in protected status or things like that, where there's a deemed sale, in the US there is actually a separate tax when people die and they hold property. And that tax rate is pretty high. Basically, it ranges between 18 to 40%. But when you get up to, having property over $1 million or taxable property of over $1 million, the rate is at 40%. So that's a fairly high rate. And for a Canadian who has a U.S. vacation home or a U.S. real property, because of the fact that the property is located in the U.S., even though you're a Canadian, you will be subject to this tax. And U.S. cited property is defined as obviously U.S. real estate, but also includes U.S. stock. So your Apple holdings, your Google holdings, they are U.S. property for this purpose, as well as U.S. mutual funds. So those things are the type of assets that will be subject to U.S. death tax. And, and a lot of people would ask, well, but I have those in my RSP. I have those in my tax-free savings account, or I have those in my RESP. From a U.S. perspective, that's not a relevant factor. They only look at where is the property located. Is this a U.S. cited property? Unfortunately, under the treaty between U.S. and Canada, there is pretty good relief in the form of this unified credit. And what this credit is they allow you to prorate the credit based on your U.S. assets over your total assets. So when you do the math, basically how this credit works and its end result is that unless you have worldwide assets greater than 5.43 million for 2015, there wouldn't be any U.S. death tax owing because of the unified credit. And on top of that, you can also elect to have your spouse take over your assets, and you get another set of credit for that. So, even though this tax sounds painful and the rate is very high, there's pretty high threshold. So if you're sort of fortunate enough to have worldwide assets over 5.43 million, what are some of the planning options that you have to deal with this U.S. death tax? And the truth is, really, every case is unique, and you need to look at sort of the profile and the type of assets to do proper planning. And some of the option would be you hold your assets in a Canadian corporation, and like we said earlier, that causes Canadian problems. You can buy life insurance to pay for this tax. The downside, obviously, is that the value of the life insurance will actually increase the value of your estate. So sort of it's a catch-22 scenario. You can decide to sell your U.S. assets early, quote unquote, but that way you trigger current taxes when they're sold. And the next thing is, I think a lot of people think it's a good idea, but it's actually a very bad idea. And that's the notion of, I'm just gonna give it to my kids. I'm just gonna gift it. What can happen? In the US, on top of the death tax, there's a gift tax. They're actually the same tax, and they're at the same rate. But the bad fact about this gift tax is there's no treaty relief for gift tax. Like I said earlier, for death tax, there's that prorated credit so that you're protected up to 5.43 million of worldwide assets. But there is no treaty relief whatsoever for gift tax. So you're on the hook for that tax if you give it out to your children. And also, the US gift tax that you pay, it doesn't translate to a foreign tax credit in Canada. So that's a bad scenario. So try not to give stuff out to your kids. Not that you don't like them. The other option is that you can take out debt, because how the death tax work is that you can actually deduct the amount of the non-recourse debt from the taxable amount. But non-recourse debt means that the bank only has recourse on the property itself versus on you personally. And this is the kind of debt that will be not that easy to get. So that's the sort of the downside. But this could be considered because the fact that it would actually and would reduce your taxable amount. And then the last option would be you can use a Canadian LP, which is a reverse hybrid, because that way, when you check the box to have the LP tax as a corporation in the U.S., you actually deal with the U.S. death tax, but also because the fact that it's a partnership in Canada, there is no shareholder benefit rules because it's not a corporation. So you actually would cover both sides of the fence. But this type of planning has to be done very carefully, and the paperwork has to be perfect, and it's very expensive and complex.